Real estate investing can bring big reward and big risks. So know your risks. Welcome to the Real Estate Risk Report, the show for real-world insight on real estate investment risk. Now, here's your host, Lance Peterson.
Thank you for joining the Real Estate Risk Report. I'm your host, as always, Lance Peterson. So today I have with me Solomon Gorlick with Red Tower Capital. Solomon and Red Tower are verified gold members. My day job at Verivest, they recently became verified gold members. I've known Solomon for a number of years. We've been active in the private lending industry for a long time, as so has Solomon and his team. So we're super excited to have him on the show today. How you doing, Solomon?
Great. Really good. Happy to be here. Thank you.
Yeah. So I think you're down in the Bay Area, right? Where are you at specifically? What town are you guys in again?
Yeah, we're in San Francisco. Our little office here in San Francisco. I actually happen to live here in San Francisco also.
Very good. Very good. So not everyone's leaving San Francisco. Solomon has stayed. So
yes, it's me and a handful of others. Used to be 800,000 or so, but we're down to a few. No, it's not quite that bad yet.
Yeah, exactly. But you read the media and the news, it makes it sound like everyone's leaving California. Certainly everyone's left San Francisco, which of course is ridiculous. But why don't you share with us sort of how you ended up getting into the private lending business and, what sort of attracted you, into this space and, ultimately led to the formation of Red Tower Capital?
Yeah, for sure. Many years ago now, I can try to count, but it's kind of a big number. I was doing something different. I was writing software, and on the side, I was trying to learn a little bit about real estate and thinking about investing in, properties for the first time. And so I was reading quite a few books, and after my last software project finished up, I thought I better, learn more about real estate directly, and was looking around and didn't know much about the industry back then. And I just walked into a brokerage after seeing an ad in a newspaper. So that's how long ago this was. And so I walked in and met who became my broker that I was working for, after that for a little while. And they did loans and they sold some real estate here and there. But he told me on the side, one thing he used to do was to do private loans. And so that's sort of where it all began. And the first loan that I did, somehow we brokered a loan to a competitor of ours today. And I was hooked. I thought, there's got to be a way to make a dollar doing this. So that's where it all began.
Yeah. So for you guys, the types of deals that you do in particular, so there's lots of, obviously the private lending business has exploded. And there's, the banks have really retreated and given up, much of the ground they used to occupy. And so for you as sort of an underwriter and originator of loans, what's your box look like? What kind of borrowers, what kind of deals are they mainly, single family, small commercial, or what is sort of the underwriting criteria look like for you guys?
Yeah, for sure. We're always, as a private lender, trying to get, relatively high yield, certainly compared to the banks that are out there and other, more institutional oriented lenders. We're trying to figure out how do we get a higher yield in a reliable, safe way. And in every market that changes a little bit with time, because like you said, the banks or the mortgage bankers, do a little bit more or less and change the nature of what a private lender maybe can do profitably or as profitably. In any case, in this market, we're looking like we're always looking for bridge loans of all kinds. And of course, we're only, real estate focused, obviously. So it could be residential loans, commercial loans, small commercial loans typically. We do a lot of fix and flip loans. This owner occupied bridge loan stuff is of interest to us lately. And, any other commercial properties often are hard for the average borrower or, lender or broker to place particularly fast enough. So, and these are the kinds of deals we do. One of the other niches that's come up recently, I'm not sure if this is a dirty word here on the show, but we found a lot of great loans in this area over time because there's even less competition, is licensed cannabis real estate loans. So that's certainly one other niche of ours that we're exploring in addition to all these other ones and making loans on.
Yeah, no, I mean, I'm in Oregon, so cannabis is not a dirty word in Oregon. It's a way of life, from what I hear. So, uh, but yeah, no, I think it's interesting, right? Like that's just it. There's a lot of opportunities out there. You do see, things change, things like cannabis. Of course, banks, as we all know, aren't interested in, for a variety of reasons, of making loans on properties like that. And, just it opens up opportunities for others to participate. I mean, I think that's what private lending is fundamentally, is it's much more nimble, ability to act quickly. But with that, and I think that's why we do the show, right? Is that not all private lenders are created equal.
Yeah.
And so, when you're lending money, I think, and you've been in the business longer than I've been in the business, but it's just, I think to outsiders, often it looks like it's easy. They think it's just, if they got some money, lending it out at 8, 9, 10, 11%, oh, it's just a piece of cake. I mean, obviously in California, they don't just let anybody do that. You have to have a lender license. But I think a lot of people think it's easier than it is, and most of those people who end up trying it, they realize pretty quickly it's not as easy as it looks. So maybe share with us a little bit of how your underwriting philosophy has developed over the years. Just how you go about. One, money's fungible, right? It's sort of a commodity that many people are out there. Like you said, it's very competitive in California. So how do you ensure that you and your team and your staff are adhering to an underwriting criteria that's going to ensure that you get paid back plus the interest that you guys are contractually owed?
Oh, this is a great question. I mean, this is maybe the central question all the time. And maybe to start with, I'll use an actual little example that we're working on this loan right now that we're closing, because it can illustrate a few things with that related to your question. And so this loan scenario goes like this. We got a call on Thursday, last Thursday. This is today's Thursday also, but last week, just before July 4th weekend. Hopefully it doesn't make problems with dating the show, but we'll throw that out there. Little risk, you can clip this one out. But anyway, we got a call Thursday evening and by a broker we've done some business with. And he said, hey, Solomon, I got this loan scenario. We got these buyers in contract. The fellow happens to be in Southern California. The property happens to be here in the Bay Area. And the borrowers are in the Bay Area. And they said, hey, we need, or the broker said, hey, we need to, close this. I've been working on a relatively regular loan, but it was a bank statement type loan. And apparently they were quasi approved for about 5.5% interest. And they're buying multifamily property in a nice part of the Bay Area, 7 units, and they're trying to get 75% loan to value, which is quasi aggressive on 7plex, particularly for most lenders. And in any event, they said, hey, we were really trying to close this. And owing to COVID, again, another dating element, owing to COVID, they sent the appraiser out, and that appraiser apparently got COVID, supposedly, and then he handed it off to appraiser number 2. That appraiser supposedly also got COVID, and now they recently handed it off to appraiser number 3. I can't make the story up. This is apparently what's going on. And so all the while, the buyer's in contract, but the seller's like, we're trying to close here, and I know you're, that's continued on a bank loan, but you've been at it for 60 days. And so, the mortgage broker calls us up, here we are, day 60 or pretty close to that. And he says, again, last Thursday, what can you do? I said, well, there's no way we can get to 5.5% interest. And we really prefer not to be 75 or even 80%, which was what they were asking, but we'll do 70%. We think about this. We have, we've underwritten the property from what you said briefly, and it looks pretty good, at least pre-underwritten it. So we'll do that. And they said, well, we can't bring in another 5 or 10%. But what we do have is parents, and they have another property, and we can cross that one. So we said, okay, this is great. So it's a tentative handshake deal. We said, all right, well, let's take a look at the properties immediately. We drove out there, no big deal, or I drove out there. I'm constantly driving around anyways, and visited these 2 properties, which are just a few miles from each other in the same town. They're in Berkeley, California. And so we visited them. The broker toured us on one, the listing agent. The other one was open or vacant, and the owners, the borrowers, really one of the child of the parents showed us around there. And so in this period of time, we were able to visit the properties. We could do a rough analysis on on the value after getting some of the data, rent rolls. We obviously saw what the property was in contract for. The house was pretty easy. We drove the neighborhood. We got, comps from our MLSs, and these days Zillow can do that for you. And then, based upon that and ultimately getting title on the other property, we could determine pretty quickly in the past handful of days altogether, and even over the weekend, that there was a loan here, at least if the borrowers were willing to cross the other property.
Yeah.
And so they told us, okay, we're willing to do that. And our combined LTV is a little more than 50%, we think, because the buyer also had some big down payment in escrow already. So I think, looking at this the other way, this tells us a few things. I mean, coming to quick underwrite, price per foot, we already kind of roughly knew what that was. What was the borrower's, what is our belief in the rough value of the property on a per foot basis? One was in contract, another one wasn't. We had an actual price, so we were able to leverage that simple idea because it's a familiar market to us and we can comp it out. We had price per unit on the apartment building, which was in the range of reason for that city and that market and the condition of the property, which is actually quite nice. We did a little valuation metrics on the apartment building, which is how they're often traded, GRM, and looked at our estimate of a cap rate based on leasing up one of the units that wasn't leased up, which was the nicest unit in the property. It was a big house, plus 6 other units basically. So we were able to do all that work. And then we had one of the title reports, got another one, and we're able to confirm that, okay, they're both free and clear and title's clear. So, with that, I mean, this is what somebody has to do sometimes in a market like this to get a deal done.
Yeah.
I think it's not always like that, but this is the borrower's good borrower. They're just in a hurry. So
Yep.
Looking at it the other way, this is a scenario that doesn't happen as often in competitive markets, but sometimes happens. And, as a lender, whether, like you were saying, an individual investor who's just trying to make a loan at 8, 9, or 10%, or somebody, a group like ours that's trying to continually put money out for the benefit of our, mortgage fund investors, but also deed of trust investors, and make hopefully a secure dollar along the way. You got to be ready. I think in this example illustrates that sometimes you just, jump out there, leverage your market knowledge, get in the car, visit the property, shake the hands, do the work. And if you can put all that together fast enough, you can, essentially beat the other guy on a, loan to value basis or speed to market basis. And that might help you get a loan closed and at pricing that you think is reasonable. So Hopefully that wasn't too long of an answer, but
no.
With that, we rolled in a few elements.
Yeah.
Related
It shows you it's like, being established in a market, being part of that ecosystem in the community. That's how you got the deal at your door, and being able to kind of, move quickly, right? Like it's the speed, it's all the problems. I'm assuming these guys will, so now what'd you do? You write the deal for 12 months and they're probably going to refi out sooner than that, or is that that
was a tough part of the negotiation. And in the midst of, it wasn't quite like this, but it sounds good on our show. In the midst of having my July 4th burger and beer, we were having this conversation about, okay, well, what are the deal terms? Actually it was the day before on Sunday, but but anyway, so we were having to work that. So we ended up with a 1-year loan. They don't think they need to hold the loan for at least 3 months, but we somehow negotiated 3 months of minimum payments. So at least we're getting some yield there. A couple points to our company for putting it together. Another point for the broker bringing the deal to us. I think I said 9% interest in an interest only deal, and the LTV is again pretty low. So I think there's a win-win-win. We also had to throw in as the last element, or we thought we should throw in, trying to find wins in all these deals, a release clause. So we said, hey, if you pay us X on the house, we'll release that if the parents get tired of waiting. If you pay us, about 3X on the apartment building, which is less than they thought they can get from the other lender, we'll release that. So they could either pay us all, pay the whole loan off if they could, based on what they think is going to happen. But we also made it easier for them to exit with a smaller amount.
Yeah. And I think that's just it. It's the solving problems and that's where, they all have stories, right? These deals have stories and getting them to the finish line. So then, you mentioned it too. And so for you guys, you have, two parts of the business ostensibly. I mean, you've got a discretionary fund that you can use to fund your loans where investors are investing money into the fund. And then the fund holds a bunch of loans. And so they get sort of the diversified exposure to multiple trust deeds. And, but the benefit of getting a ongoing income distribution, and then they've got a right to redeem if they want after some period of time. And then you also sell, you'll take some of these loans and people can buy one-off trust deeds, right? So you originate them, you service them, and they can buy them. So how do you guys determine, what loans go where? Is it more of like there's a right of first refusal for the fund to get whatever it is if there's money there, or is it based on, how do you determine like where?
Yeah, I mean, simplistically, that we think about it like the fund investors or the fund itself is, committing, and its only manager is our company, Red Tower Capital. So we generically believe if there's anything that comes by that fits the criteria of the fund, and there's space in the fund, obviously that's kind of most important practical consideration, available capital in the fund. We certainly put the, loans there first. There's some examples of things that don't work. We're not hunting around for lots of land deals for the fund. Generally, we don't want those. I mean, so if we think there's a good land loan, we might not put it in there. But in general, we're always, and we have been historically very, successful at this in the sense that we've been essentially not in cash ever in the funds. So, but we're always looking at it as a priority way to place these loans so we can keep the fund money working for all the investors. So we have a line of credit on the fund too, as I think you understand, and that helps us do that. So we stay in cash.
The cash management. Yeah, exactly. So for you, having been in the business, and there are a lot of private lenders in California, I think it's sort of the mecca of private lending.
Yeah.
What are the things that maybe you see some other originators doing, that terrify you, right? Just because just things that are sort of like, because it is competitive, and of course it does come down. People are like, hey, well, if I can get it over here at 8, and you quoted me at 9.5 or 10, or you'd only go to 70. I mean, what are those things that you think investors should be looking out for? That are just the quick things, the things that you see that you're going, oh my gosh, I can't believe that those guys are doing that.
No, there's a lot of those. I think in many ways our business or lending is, us and our competitors, the industry in general, was very simple, right? But the challenges, like you just explained, is there's always competition. Sometimes there's more competition than otherwise. And I think in this market, in many ways, there's more competition today than a few years ago, I would say. And I agree, California is pretty competitive. It's obviously the biggest state by population, so there's lots of real estate, but there's a lot of players that like to lend here, and then institutional buyers that like to buy here, which keeps pricing relatively competitive from a borrowing point of view. So I think, all the obvious things are problems. I mean, if you're a passive investor and you're trying to underwrite your own loans, starting there for a moment, I think the risk that a part-time passive investor faces when sort of being presented by, we'll say, 2 mortgage brokers pitching them theoretically the same deal, which almost never happens, right? But if you could theoretically create that scenario, or think about it anyways, broker A saying, hey, I got property A here, we have an appraisal, we ordered it, this may be an accident, or on, some of them on purpose, but most of them will say accident, and let's say the value's wrong. They came up with the value, their appraiser came up with the value, however they got it, of $120 or 120,000 or 1.2 million, whatever.
Yeah.
And I always try to think in small numbers for purposes like these. And then you have broker, and he's saying, hey, you're going to be 70% of that number, or I guess that's whatever, $84.
Yeah.
And then broker B says, hey, I got this same deal, and it's a value of $100. And and the appraisal says it's $100. And I'm looking to do, maybe 72% of that number, we'll say, or something, just to make these numbers sort of fit our conversation. And so that's 72% LTV, a little higher than most people theoretically want. But anyway, these deals, it's hard for most people to really compare them properly, even if it's the same interest rate, same other information, same kind of presentation. It's, really it's about what is that appraisal? What is the darn thing really worth? And believe it or not, this is such an obvious problem, but it's still a problem. It's the problem no matter what you do, because in the end, if it's a refinance, there's not an actual market transaction that this specific loan is directly focused on. So, quote unquote, nobody knows what the value is, right? It's a subjective analysis, and 20% off is not totally insane. That it's possible somebody could be 20%. So anyway, valuation is a big problem. Clear title is another obvious problem, that usually is addressed, but sometimes isn't, because a lot of people might not go through, oh, this is what a prelim is about. And this item here, don't worry about that, investor. This item number 3, that's a federal tax lien or some other thing. Yeah, we got that taken care of, but really or some other lien, that monetary lien that's not going to be paid off, or looks like it's going to be paid off, or they assume it's going to be paid off, but isn't. You can imagine all these problems, and just getting clear title for folks that are not understanding how the transaction's supposed to work, or how escrow instructions are supposed to happen or be managed, is another basic issue. So I think those are some of the obvious ones. I think future value appraisals versus as is appraisals is sort of another one. Lending to borrowers who are just have no history of performance, but then trying to tease that out through this process can sometimes be challenging. And so does it come back to like dealing with the mortgage broker who has done this for a long time? If you're buying a loan, it's probably an easier, safer route. Mm-hmm. They have, generally more deal flow. Hopefully they're explaining it well, or obviously I think generally it's a pitch for, mortgage funds that have been around for a while, because I think a lot of investors, don't really want to underwrite the loan and compare loan A to loan B on an underwriting basis. And a lot of these folks are they like the idea of choice. And I think that is in many ways in control, which theoretically one has in buying a whole loan or half a loan. But a lot of passive investors really don't have the ability to underwrite a loan in a competitive market compared to folks that are in the game daily. I think that's the truth. And so really then it's about, is the sales guy calling them about the loan more effective? But that doesn't mean their loan is a better loan to have. So I think that's a big risk potentially.
I think that makes sense. Yeah, it is. It's like when you say it out loud, okay, it sounds simple, but it's just, those are the things that can easily be overlooked. I mean, the value discussion, like you said, is central, and it's just, anybody can tell you, oh yeah, this is a 60, it's a 65% LTV on this loan. Yeah. But if your V, like you said, on a refinance transaction or whatever, who came up with the V and LTV, right? You did, right? Or, and even, I mean, I know, and I've heard a lot of guys like in your shoes, like, I mean, even when they get an appraisal back, if they're going, wow, the number's too high, I just don't think it's worth that. Right. So, I mean, it's not always the case that you take even with the appraisal at face value. It's sort of, that's what's required to be a savvy lender, is to say, okay, it's a data point, but what do I think it's worth? Right. And those are the other risks. Where's the property located? What kind of property is it? What are the exit strategies? Who's the buyers? I mean, in single family, it's a bit easier because it's more liquid, right? It is real estate's inherently illiquid, but single family residences, they're, especially if they're below the jumbo, limit, right, are just easier to trade. You can get rid of them. So, looking at the underlying collateral, and like you said too, when you got those sticky situations, the ability to go in and cross collateralize, right, to achieve your objective, have them throw in more collateral. It's just, those are some of the things that, not everyone knows or does that, to negotiate and put together these transactions, they can be more complicated. And then even in that transaction, I said clear title issues, insurance issues, right? That other sort of thing where it's like, you got to keep tabs on, like, are these properties insured as the lender, right?
For sure.
Because that's a big risk, but it's stuff that people overlook, that they're not monitoring and ensuring that, that they're on the policy. And I mean, if the policy lapses, and not having forced place or, those sorts of things, it's just that those are huge risks. I mean, because things can happen, and, the house burns down or the building burns down and there's no insurance on it. You're not getting paid, you're not getting your principal back. Right. So something that you thought you were high and dry on and everything was done right can go to zero. And I think that is the power of these, mortgage pool funds or the debt funds, where you have exposure to multiple, many loans, right? Because even if something does, if God forbid something did go sideways on a particular deal, you're not gonna, you're not going to feel the pain as much as if that was the loan you were on, you own that particular loan. And a lot of funds too, most of them are supposed to, have a loss reserve. So they're actually, they're actually holding some of that back, assuming that there's going to be some sort of delinquency or, potential, writing off interest that you've accrued for or whatever. So let's get into the cannabis thing.
Yeah, sure.
Maybe just share like what was the process you went through to kind of get comfortable with, underwriting properties that are being used for, businesses that are affiliated with, in the cannabis space.
Yeah, that's a great question. We really, in some, we'd like those loans coming right to your point in a moment, mostly because like the risk reward on a licensed cannabis loan today and yesterday, and hopefully tomorrow for a little while, is better. So that's why we're there. We're not there because we're here to promote that other industry, we'll call it exactly. We're there because we think these are better, loans to make, real estate loans to make. And so, yeah, as it happened, of course, here we're in California, which, I think popular culture knows is sort of one of the birthplaces of cannabis, so to speak. But in fact, in terms of law, it was in '96 that California passed the nation's first medical marijuana law. So California, has a culture of this, a big state, a lot of growing, of course, Oregon also, particularly Northern California historically. And most of that I was unaware of until I started looking at this, and we looked at this as a group. But around 7 years ago, we started getting calls, just I think basically because we were a private lender and somebody searched for private loans, we'll ask the private lenders for a loan. And so probably us and our competitors got a whole bunch of these calls, even as early as around then, and many before, let's say also, just being here in San Francisco. And so we started having some of these conversations, meeting with some of these people who are in the cannabis industry and trying to understand the space. And we started visiting some of these properties and looking at a bunch of these spreadsheets where people explain to us, hey, look, if you invest $1,000 or $1 million here in this property, we'll be able to put in this number of plants and this many lights and this much HVAC, and we're gonna, make this much money, and this is the expenses, and sort of their pro forma on cannabis cultivation. We saw quite a few of those. We started looking at these properties, not that they're all cultivation properties or were. And, we took forever to try to understand this, at least to some degree, in our minds, because very, unfamiliar. We know what a building is. We don't know what, growing plants is about, for example. And this is when it was medically legal, but not yet recreationally legal when we started looking at that. So, it took quite a few of these rounds and a bunch of property visits and a couple of years even to come to terms with this as sort of another thing that we could be lending on, or scenario that we could be lending on, in addition to bridge loans, fix and flip loans, and random other loans that were way more familiar to us for many years of having done that. And so finally, after a couple or so years of looking at this, we made our first loans, and we looked at them, and these are mostly have been in so far warehouses, because in general we like buildings versus land, although we've occasionally lent on land. So they just happen to be warehouses, or these were warehouses that just happen to have, in generally speaking, urban areas for the most part, that just happen to have cannabis plants or cannabis activities, going on there. And it was a process to get to understand this a little bit, but that's really all it was. It was just a different type of business there, and different type of licensing regime. Just as we might look at a contractor and check up his or her license, we might take a look at, and there's some details with this, we can talk about that. Look at for a licensed cannabis business, whether a cultivator, or distributor, or some other type of business. So we had to become a little bit familiar with these, and then these rules are changing all the time, and it is a little crazier than the contractor license example, but it is basically in the end kind of the same thing. And so that's how we started looking at it. And then as we make one loan or two loans and mention that to folks here and there with some of our marketing, we get loan 3 and loan 4. And of course, just like every deal, we got to look at a bunch of them to decide that these make sense. But the flip side is very few lenders are really reliable. Private lenders are really reliably or quasi-reliably lending to this industry. So we see it's a smaller, amount of. A couple quick thoughts here before I turn the mic back. A couple of quick thoughts here are, the available, properties that are, call it licensed cannabis properties, let's just say in California, is a pretty large number, but definitely dwarfed by every other piece of real estate collateral that can be lent on, certainly including houses or warehouses generally. So it's a tiny market, but the flip side is it's a market that's underserved, and most people can't even don't see deal flow in to understand what the market's about, and don't speak the language of the borrowers or the tenants in this space. And so that's part of why we like it. We get to see the deal flow that not everybody sees. We can compare it to the next property down the street that we have lent on, and we think we can make, and so far have made, superior loans in this space versus some of the other stuff we could otherwise have lent on.
Yeah, no, I mean, it makes a ton of sense. And that's, once again, it's because the banks aren't willing to do it. It shrinks it down. Your premium, the ability to generate the above average risk adjusted return is there. That's a lot of what it is when you're investing in the private markets. It's just, it's about, there's inefficiencies all over. Right.
Mm-hmm.
And I think right now that's an inefficiency. And so, as an investor, that's how, whether you're active like you are, Solomon, or if you're a passive investor, it's how we all need to be thinking. It's just what's going on? What are the trends? What's happening? What's moving? And what kind of inefficiency are those movements creating and making, and opportunities that you can, jump into things. And I think that's why it's important to be curious and inquisitive, and not, I think, as a passive investor, because I think what I hear from a lot of investment managers, deal sponsors, is that, investors, they've got about, 3 questions they can ask. It's obviously there's somewhere there, but it's just like, good skin in the game. You got whatever. You can tell that it's just really high level stuff. So it's like, okay, It's okay to seek to understand, like, tell me how you do what you do. Why do you do what you do? That's sort of the line of questioning one should probably be asking, because that's how you'll be able to ascertain whether or not, a guy like Solomon is a thoughtful investor or not, right? Is there a method to his madness? Does he have a philosophy? How does he approach things? And that goes with everybody. So on the cannabis thing, just to kind of close the loop, and we'll wrap up. How do you deal with the money issue? Because isn't there they have the banking issue as well? So then, how do they get, how do they make their interest payment?
Yeah, believe it or not, what we've told every borrower in this case since day zero is, we need to be paid only in what we call bank money, so to speak. But of course, just meaning that it gets transferred in the bank in kind of the normal way that people pay for loans. So, we say, hey, we're not, accepting cash, and, all the funds that we receive in general are deposited directly into the bank account, let's say for the fund or with the servicer if we're fractionalizing loans. So they've understood that from day zero. And so almost every payment we've ever received, although if you have asked, has been a check, a mail check, a wire, an ACH payment. And believe it or not, I think the way that most of the businesses are handling that issue, because I agree that it's still an issue, although it's less of an issue today than 2 years ago, and hopefully less of an issue 2 years from now. But like you said, it is still an issue, is because as more of them get legalized, and we've been dealing with that group, they, at some stage along the way, they have some degree of banking, and it's becoming more and more formalized, whether it's for a personal bank account, so to speak, that they're using for business, or a formal business bank account, that they can write checks from. We've seen it a few times, like we know the borrower, it's an LLC, but the fellow's writing us a personal check. So how he or she's getting that money in there from the quote unquote business to his personal account, but paying his mortgage under the name of the LLC. Not exactly sure in all cases, but that's essentially what's happening. I think what's happened generically in the industry, not everybody, but a lot of it is in some ways, some participants are receiving cash or part cash, and some they use some of their expenses in cash. I think this is no surprise to anyone that's talking to folks who are in the industry or is in the industry. They make some payments in cash, maybe a lot of them, maybe most of them, and there's certain bills that they don't pay in cash. And the most obvious ones that I hear and see about all the time are things like mortgage payments and rent. That's often not paid in cash. But a lot of other things are paid in cash. Other vendors in the industry, contractors that do work for them, and, how all that's, really managed when it comes down to their books is a whole nother story. We're not in the accounting business. I'm not sure.
Yeah,
but I know that we've been receiving monies these ways.
Yeah.
And
No, and I think that's the big, I mean, until we get some sort of federal legalization, it's because, so much of that banking infrastructure is federally regulated, that's a bit of that, it's the beauty of this country, right? It's the United States of America, right? But it's also what at times creates, madness with taxes and, and securities laws and lending laws and whatever, is that every state does have some level of autonomy. And I know it drives most of us crazy, but to me, it's like, we got to pan out and think about, that's what makes this place a great place, is the checks and balances, the fact that, we do have, multiple levels of government and those sorts of things. But it creates, once again, to me as an investor, you have to look at it like it creates inefficiency and therefore an opportunity, right? And ultimately the premium that you are charging them for, providing them with financing of a building and such is outsized for probably the underlying risk, which is what we're all shooting for. So where can people learn more about Red Tower and what you're up to? Where can they find more information other than going?
Yeah, of course, that's the obvious first place they should go. But after Parivest, they should find us at our website, which is redtowercapital.com. Yeah. And we'd be delighted to, interact with them, explain more about what we're doing. If I could just touch on what you were just mentioning for a second, I think that's spot on. There's a lot of aspects to, making any of these loans, but I think interesting with the cannabis loans, particularly, that it just makes them a little bit harder. And I think we were talking about how fragmented the legislative aspect of the whole thing is. And so what you find in a place like California or any of the other states, but California we're very familiar with, is every city and county can theoretically have their own legal structure within the framework of the California, call it cannabis laws. And so it's really fascinating. And that's a zoning related issue. What property, for example, in a city like Oakland, which is one of the early participants in this space, both in the legal and the traditional or illegal market, but certainly in the legal market today, they specify properties in this area, according to this map, can be used for this cannabis purpose. Of course, they have regular zoning, but we'll talk about the cannabis aspect. And you'll find the same thing, greater, lesser well documented in another city in the Bay Area or another part of the state. So you have a whole regimen around, can this property be used for this purpose or not? And of course, it's a police power issue, so that the city or county can change that whenever they want, theoretically. Of course, they're generally not changing things too quickly, but that's one element. And so that affects value or utility of that property. Normal zoning, of course, but also you can say cannabis zoning, which creates opportunity or for buyers of that space, lenders of that property, and users of that property. And it's really quite fascinating and how it's done. And then you get to appraising these properties or valuing them. And that's just as complicated as valuing every other commercial property, but you have 2 or 3 extra overlays. So is even more complicated. And then you get to, but really all this complication, coming back to what you said a few moments ago, really does create theoretical opportunity for all the participants. It creates opportunity for a potential user or tenant, creates potential opportunity for the owner of the real estate, and it certainly creates opportunity for lenders willing to try to understand what's going on there. And a lot of lenders won't get it right. A lot of buyers won't get it right, and some of the tenants, believe it or not, also won't get it right. Yep. But it's fascinating.
No, it is. It's great. Yeah. And I love the conversation because it really sheds a light on the role of a lender, right? It really is. It's constantly assessing and recalibrating the risks that are inherent, right? And doing everything you can to, like we talked about, cross collateralization or understanding municipalities and the rules, the laws. I mean, all those things you have to do. It's wiring the money when you've decided to fund the loan, it's relatively simple. Everything that happens before it and much of what happens after the money goes out it's a lot of moving parts. So, well, thanks so much for your time, Solomon. As always, I appreciate our conversations. Have a great day.
Likewise. Thanks a lot, Lance. Appreciate it.
See ya.
Bye.